Hello students, welcome to EPG Pathshala. I am Inderveer Singh from Central University of Himachal Pradesh. Today we are going to talk on module National Income Concepts and Measurement from paper Managerial Economics. This module has two learning objectives: to understand the concept of national income and to learn the use of national income concept to understand economic issues. This lecture scheme of lecture is we are going to discuss 5 points. What does national income mean? Then nominal versus national, then nominal versus real income. After that, we will talk about concepts of national income and three approaches to measuring national income, limitation of national income concept, and the last we will summarize. What does national income mean? National income is one of the basic aggregate measures in macroeconomics, which provides a comprehensive objective measure of welfare of the people. National income is the market value of final goods and services produced in an economy over a specific time period, usually a year. The importance of measurement of national income can be understood from the fact that two Nobel Prizes to Simon Kuznets in 1971 and to Richard Stone in 1984 were largely awarded for their contribution to the development of national income accounts. An aggregate measure of economic welfare of the people is useful for understanding economic relation and formulation of economic policy. Economists use these aggregate measures to improve their understanding of economic activities and also to measure the welfare impact of different factors. In absence of an aggregate measure of economic welfare, the government policies cannot be evaluated and the policy decision will be based on subjective valuation of policymakers rather than the scientific established facts. Therefore, it's crucial to have a quantitative and objective measure to welfare. The problem of using subjective measure is that it is prone to be misused by researchers to prove their own points of view as well as by policymakers to impose their own point of view on others without a sound reasoning. Besides, a quantitative measures cannot fully capture temporal changes or regional differences which are required to measure the effect of economic policies. Though the explanation of national income concepts is straightforward, it's incomplete without a discussion on difference between nominal and real income. Slide 11. The change in national income is a result of combined effect of quantity and price change. However, the economic welfare depends only on quantity change, and the price increase or decrease does not lead to welfare increase or decrease. For instance, the welfare effect of a good or service does not increase with just because its price has increased. Only way to increase the welfare is by increasing the production of a good or service. Therefore, the effect of price change on value of production must be removed. The market price based on value of production provides nominal income change, whereas the price adjusted value shows real change in income. Let us take the case of single good to clarify the point. Suppose wheat is the only commodity produced in an economy. Therefore, the income estimate must be based on wheat production alone. In one of the year, the price of wheat is rupees 100 per ton and 20 million ton wheat is produced. Based on these two figures, the value of wheat produced is rupees 2000 million or 2 billion. Now compare the two possible scenarios for the next year. In the first scenario, the price of wheat increases to rupees 110, whereas production remains the same. In the second scenario, price of wheat remains the same, that is rupees 100 per ton. However, the production of wheat increases to 22 million ton. In both the cases, value of production will increase to rupees 2200 million, showing 10% improvement in the value. However, the two scenarios are fundamentally different. In the first case, there is no real improvement in welfare of the people, as production of wheat has remained the same. On the other hand, the second scenario shows improvement in production, as more wheat is available to people for consumption. Remember, the economic welfare of people depends on level of production and not the prices. In above example, the value of production is nominal income or value. To obtain the real income, we have to calculate the value by keeping the price constant. For example, in the two scenarios discussed above, the real income in the second scenario is rupees 2200 million, as the whole change was a result of change in production. Comparing the real income in two scenarios, one can conclude the second scenario represents welfare improvement, whereas there is no change in the first case. The above example considered two extreme cases, whereas either price or quantity was changed. In reality, both price and quantity changes simultaneously. For instance, the production may change from 20 million ton to 22 million ton, and at the same time price may change from 100 per ton to rupees 110 per ton. In this case, the nominal income will increase from 2200 million to 2420 million, whereas the real income will change from rupees 2000 million to rupees 2200 million. While determining the real income, the price for one of the year is considered as the base, and all the incomes are calculated by multiplying the base price with the quantity produced in respective year. Also, note that real and nominal income is same for the base year. The above example is based on just one good. However, the same principle can be used for several goods and services. For example, suppose there are n commodities with price P10, P20 up to Pn0 and quantity produced Q10, Q20 up to Qn0 in the base period. Here the first subscript number denotes the commodity number and second represent time period with the base period written as 0. For example, P20 is the price of second commodity in time period 0. The value of production in the base period is summation Pi0 Qi0. Since it is the base year, this value represents both nominal and real income. Let the quantity of n commodities produced in period 1 be Q11, Q21 up to Qn1 and their respective prices P11, P21 up to Pn1. Then the nominal price in the second case is summation Pi1 into Qi1, whereas the real income is summation Pi0 into Qi1. To calculate real price, one may also use price index. For instance, one can divide the nominal income Pi1 Qi1 with price index and multiply with 100 to obtain the real income. The price index used in the case of national income is called implicit price deflator. We will further talk about it while discussing the various concepts of national income. Due to technical difficulties in the measurement of national income using constant prices, implicit price deflator is more convenient way to calculate real national income. Let's discuss concepts of national income. What is included or not included in national income? The previous discussion have given us the basic idea about measuring national income. However, some issues still remained unintended. The important ones which need to be discussed here are how to avoid double counting. Second, what is to be included in the calculation of national income and what is not to be. Third, how to measure the contribution of goods and services produced by government. 4. How to include change in inventories and unsold stock. First of all, only value of final goods and services are included in the calculation of national income. Inclusion of intermediate goods leads to double counting, as the price of final product will also include price of all inputs. It must be noted that, however, capital goods are also used in the production of process. Capital goods are also used in production process. Nonetheless, they are considered as final product, because capital goods, unlike raw material and the other inputs, are not completely consumed in the production process. Their contribution is equal to their depreciation only. In addition, non-market production activities are not included in national income. For example, the service of a housewife are not a part of national income, whereas the same services provided by a maid becomes a part of national income. The reason for not including non-market services is due to the difficulty in estimation of their value in the absence of market price. However, the value of some of the non-marketed goods is included. The imputed value of rent of owner-occupied households, wages in kind, and self-consumed agriculture production is included in the measurement of national income. Their value is calculated based on the market value of similar goods and services. The market price also does not exist for goods and services provided by government. Therefore, the cost of their production is taken as their contribution to the national income. Any resale of good is not included in the national income. However, the services provided to facilitate the resale is included in the national income. The resale of a good is just a transfer of property, and no new production activity is involved. However, the services provided by a broker is new production. Similarly, the transfer payments are not included in national income, as it is an income earned by someone else, and including it will lead to double counting. Further, the illegal activities are not included in the national income. For instance, if alcohol consumption is illegal in the country, it will not be included in the national income. However, it will be included if the government lifts the ban on its consumption. The change in inventories is also included in the national income calculation. For example, if there is an increase in unsold item, stock of raw material, etc. at the end of the year, then addition in inventories is added in the national income. Most commonly used concept of national income are gross domestic product, gross national product, along with their closely related concept of net domestic product and net national product. In addition, the concept of personal income and disposable incomes are also used. GDP is the value of final goods and services produced within the borders of a country in a year. It includes all the value of goods and services produced by foreigners within the country and excludes any production activity of the residents that happen outside the boundaries of a country. In some cases, the concept is also used to define the value of goods and services produced within the boundaries of a state, which is often referred as Gross State Domestic Product or GSDP. GDP is calculated at both market prices, that is current prices, and constant prices. GDP at market price is simply the total value of final goods and services produced within a year at current prices. To obtain GDP at constant prices, GDP at market prices is divided by GDP implicit price deflator, or simply GDP deflator, and multiplied by 100. GDP at constant prices is also called real GDP. Since the GDP at constant prices is calculated using the base period prices, the base period is always mentioned. It should be noted that GDP deflator and inflation is not the same thing. GDP deflator is 100 for the base year. If GDP deflator is 105 the next year, it means a bundle of goods which may have cost rupees 100 previous year now cost rupees 105. If the deflator increases to 110 in the third year, it means the same bundle that cost 100 in the first year now costs rupees 110 in the third year. Both the time there is rupees 5 increase in the cost of bundle compared to the base year. However, inflation is rate of change in price of bundle compared to its previous year. Also, indirect taxes are deducted while calculating GDP. The indirect taxes lead to problem of double counting, as the indirect tax is used by government to provide other service. Since the value added by the government using the same indirect tax is included separately, the inclusion of indirect tax in the price of final product leads to double entry. Moreover, the indirect tax does not represent any value addition in the product. Subsidies has similar but opposite effect. Therefore, subsidies are also called negative indirect tax. If GDP is calculated after deducting indirect tax and adding subsidies from GDP at market price, then it is called GDP at factor cost. GDP at factor cost, as the name suggests, is equal to sum of payments to factors of production, that is, wage, interest, rent, profit, and depreciation. Using implicit price deflator, GDP at factor cost can also be converted into GDP at factor cost at constant price. The following identities show the formula for calculating GDP at market price, at constant price, and at factor cost. For example, the following formulas shows how GDP of 2014-15 can be calculated using 2010-11 prices as the base. Net domestic product. Net domestic product is calculated after deducting depreciation of capital goods from GDP. As mentioned earlier, a small part of capital goods is used up in production of consumer goods and services. This depreciation lowers the value of present capital stock. Thus, a part of investment in capital goods is required to repair or replace this capital so that the capital stock can be restored to previous level. Therefore, the depreciation of capital stock is deducted from GDP so that only the new addition to the production capacity remains in national income. NDP, just like GDP, can be calculated at market price or constant price. NDP at market price can be calculated using the following identities. NDP at market price is equal to GDP at market price minus depreciation. The formula for calculating NDP at constant price and factor price can be obtained the same way we have obtained it for GDP. Gross National Product or GNP. GNP is the value of final goods and services produced by residents of a country within a year. It can be obtained by adding net factor payment from abroad in GDP. Net factor payment from abroad is calculated by taking the income earned by residents from abroad in the form of compensation of employees, rent, interest, profit, and net retained earning of companies, and then deducting the similar earning of non-residents within the country. The concept of net national product is derived from gross national product. NNP can be obtained by subtracting depreciation from gross national product. NNP is net income earned by residents of a country. The other concepts of NNP at constant prices and at NNP at factor cost can be obtained using the formulas we have written earlier for GDP. NNP at factor cost is also called national income. Personal income and disposable income. Personal income is the total income received by residents from all sources. It includes wage income, fees, rent, earning from interest, commission, profit, bonus, dividends, and transfer payments. A personal taxes are deducted from personal income, then one can get disposable income. Following identities show the relationship of personal income with net national product and disposable income. After discussing the various concepts of national income, now it's time to understand how these concepts are empirically measured. Though the concept of national income is defined as value of final goods and services, practically it can be measured using one of the following three methods: value added method, also known as product method, factor income method, and expenditure method. All methods provide the same estimates. The income paid to the factors of production is equal to value addition, and the total expenditure on goods and services is equal to income earned by the factors of production. These methods are used to arrive at the estimates for GDP at market price and then adjusted for net factor payments from abroad, depreciation, indirect taxes, and price change to arrive at other concepts. Value added method. At each stage of production, certain value is added to the product, which represent the contribution of labor and capital at that stage. The value addition at any stage of production includes cost of labor, profits, and depreciation. The production of goods also requires many intermediate products, which may be used up in the production process. Though the cost of intermediate products adds to price, their contribution to the price does not represent the value addition, as they have already been produced. Therefore, the cost of intermediate products is deducted from the price of final products to obtain the value addition. GDP can be calculated by adding the gross value of all products, intermediate and final, and then deducting their cost of production. The whole process is done in three stages. In the first stage, the gross value of all goods and services is estimated. To obtain the gross value added, the various sectors are classified under different categories. Then, gross value is estimated for each category by multiplying the output of each sector to their market price. The gross value of each category is then added to obtain aggregate gross value of all sectors. In addition, the record of the firms can also be used to get information about total value of sales and inventories. Here, one must be careful to include self-consumption of agriculture production and imputed rent of owner-occupied houses. In the second stage, the estimates for production cost and depreciation are generated. Estimation of production cost and depreciation is a complicated process. The information on inputs is used for sectors where it is easy to obtain. In other cases, the cost is based on estimates of inputs as a share of output. The depreciation is generally estimated as certain percentage of gross value based on some accepted norms about depreciation. After obtaining the estimates of gross value, input cost, and depreciation, GDP is calculated. In the third stage, by deducting input cost from gross values, and NDP is obtained by deducting depreciation from GDP. Factor income method uses payment to factors of production to arrive at GDP estimates. So the national income is the sum of three types of income earned by people, namely labor income, capital income or non-labor income, and mixed income. Labor income includes the income compensation of employees, including bonus and employees' contribution to Provident Fund. Capital income includes retained profits of corporates, dividends, interest, rent, royalties, and surplus of public sector enterprises. Mixed income has feature of both labor as well as capital income, thus cannot be assigned a category. It includes income of proprietors, self-employed doctors, lawyers, and the sum of these income provide net national product at market price, which can be used to calculate GDP, NDP, and GNP. Expenditure method. In an economy, three agencies, household, firms, and government are involved in economic activities and purchase goods and services from each other. Expenditure method is based on total spending of these three agencies on final goods and services produced within a year. The spending of households, firms, and government is termed as consumption, investment, and government consumption, respectively. The consumption of these agencies also include imports, whereas the exported goods, though produced within the country, are consumed in foreign countries. Therefore, exports are added to total expenditure and imports are deducted to obtain GDP estimates. The GDP is then used to estimate the other concepts. Now we will discuss some of the limitations of national income concepts. First of all, non-market activities of a household are not included in the national income accounting. For example, the service of a housewife is not included in the national income, whereas the same service, if provided by maid, is added. It leads to underestimation of national income of a country with a large share of non-market production. The activities declared illegal and black market transactions are also not included in national income. Using the cost of production for government services also leads to miscalculation of national income, as the production of goods and services by government often involves significant production and allocation inefficiencies. National income does not provide information on distribution of income, which is a major drawback of national income. So, students, let me summarize what we have learned in this module. GDP and GNP are most important measures of national income used to measure progress of an economy as well as improvement in the living standard of the people. National income, when measured at market price, include the effect of production changes as well as price changes. To measure the real change in welfare, the effect of price change has to be removed using implicit price deflators. The national income estimates can be generated using value-added approach or income approach or the expenditure approach. All these approaches provide the same estimates. There are also number of limitations of national income accounts. However, despite these limitations, national income concepts are widely used to measure welfare and progress and one of the most important objective measures provided for welfare measurement. Thank you.